Well, it's actually the laptop camera. We were going to use this.
Oh, it's a laptop camera?
Yeah, we were going to use this originally.
Okay, thank you so much, guys. We're gonna get started here. Show of hands of who's heard of Quant before? A few of you guys? Oh, all of you guys. So it sounds like you guys are interested in making money. Is that right?
Yes.
That's what we're here to talk to you about today. This presentation and these slides have been made very thoughtfully by our academic teams here at Sydney Quant Traders and CPMSoc. These guys have actual work experience in quant trading firms. For example, Jeff here joined us today, is our education director who recently came out of Optiva as well. Yeah.
Yep, so I'm Jeff. I'm the education director at SPG. And I recently finished up a software internship at Optima. Pretty fun.
And for those who missed it earlier, my name is Kevin. I help run SQT as the co-president. Great, so we'll get started. Just for the people who are coming in right now, do me a favor and sign up to this event with the QR code. So this is a brief overview of what we're going to be covering today. We'll be doing a bit of intro to trading stuff, about what is trading and why are we interested in it. Then we'll be going over some of the roles that are being offered right now by the trading firms, how you can get into and break into quant, and then finally some technical questions throughout to test you guys and see who's going to get the next internship. There'll also be some free food afterwards, so feel free to help yourself out once the workshop ends. So what is quant? What is quantitative finance? So quant is short for quantitative. And quantitative is using mathematical models. It's using stats, data, algorithms, research to make decisions. The idea of quant has been becoming more and more popular recently as trading in the markets goes from less intuition and fundamental research to more using actual stats to be confident that we can make good trade decisions. So quantitative finance is a very broad term, right? It covers a lot of different roles, and we'll go into later, but the industry is more than just quant trading firms. And in fact, there's a lot of different companies and industries that require quant. Starting with quant trading. Why are we in this industry in the first place? Well, a few of you guys mentioned earlier, you're likely one of them. I don't blame you. But first, we have to also consider it's actually a pretty intellectually challenging environment. For those of you who are math majors, finance majors, or STEM majors, you will probably realize that working in quant is very demanding in terms of what you need to know and what you can learn. And that's a great thing. A lot of us are trying to aim for the best and trying to learn as much as we can. And this is where the quant industry really shines here. There is no limit to how much you're learning, and you're consistently learning on the job. On top of that, we also have very high agency and ownership. So unlike a lot of traditional companies where you have a big hierarchy, and you're working for your manager, and your manager's manager, and your manager's manager's manager, quant is very flat. The hierarchy runs very flat, and so people get a lot of opinion and get a lot of say on what progress you can make in your role. And you also get a lot of meritocracy. You get rewarded based on how well you perform, and your performance is really recognized. Quant firms also provide a benefit to society as well. So by trading, we're actually providing liquidity to the markets, and that allows other people to get into the markets easier as well. So as an individual investor, you can now any day you can go to your phone, buy some stocks. But usually, if we didn't have that liquidity, you might just put an order in, but that order might not get filled. And so the fact that we have a lot of firms that are trading consistently on the market gives us liquidity to trade with. And finally, your favorite point, the high compensation. So working as a quant, you're probably getting the most competitive salary you can out of university. out of any STEM role. Correct me if I'm wrong, or shout out if you can think of something better. But it's very, very competitive. I'd say that grad rollers go from 200K plus to mid, high, six-figure digits. So the compensation is very, very rewarding as well. And there's a lot of people who go and find out about quant because they search up, highest paying STEM jobs. Oh, what's quantitative finance? And they find out that, yeah, this is actually quite a rewarding role. And it also takes you all across the world because these firms that are often in quant have a lot of offices across the world and they're open to moving you around as well. So I'll move on. You want to come to the spot?
Yeah, sure.
Yeah.
All right. So over the next section, we're gonna introduce just the concept of trading, and deal with ideas like exchanges and orders in the order book. You might have heard people say that when trading firms do recruiting, they don't really care about your prior finance experience. While this is true for like large HFT firms, there are also other reasons why it might be useful to understand a bit of like the finance side. Yeah, a beginner's understanding would be useful for mock trading games, which sometimes happen during the interview. And it's also good for having a general understanding of the industry. So yeah, let's get started with an introduction to trading. So what exactly is a trade? It's just exchanging an asset for some money. So here's a very basic example. I've highlighted in green. Just for your information, in my slides, I'm going to have some color coding. Green is going to usually be an example, yellow is going to be a definition, and blue is going to be a result of some kind. Okay, so Alice says to Bob, I'll sell you 5 Apple shares. Each share will be sold at $30, and this transfer must occur by the end of the next business day, tomorrow. And this defines what is known as a spot trade, as opposed to a futures trade. So a spot trade is an agreement to exchange assets for money with the actual transfer occurring almost immediately. Usually this is within 1 or 2 business days. And the attributes of a trade are listed in the bullet points there. You have the size of the trade, who is selling the asset, who is buying the asset. You have the quantity of the asset being traded. In this case, it's 5 Apple shares. And there's the price per asset, which is $30. And there's also the settlement time, which is tomorrow. Okay, so Alice so far has only proposed the trade. What Bob has to do now is to agree to it. And once Bob agrees to it, the trade can be executed. So what does it mean to execute a trade? Executing a trade just means that both parties are given settlement obligations. So for this example, the obligations are that Alice must give 5 shares of Apple by the settlement deadline, and Bob must give Alice the cash by the settlement deadline. And once the obligations are fulfilled, the trade is considered settled. So this is a really simple example of settlement obligations. For other complex asset classes or contracts, settlement is more complex, and concepts related to clearing and settlement are considered part of what's known as the post-trade lifecycle. So the actual trade is when Bob agrees to the trade, but then there's like all the plumbing that happens afterwards, which is sort of like boring, and we won't really get into it during this workshop. Okay, so holdings and position. At each point in time, each participant has a holdings and a position in each asset as well as in cash. So this is an example of what someone's position might be if they conduct one trade to buy 5 shares at $2 and later conduct or execute another trade to sell 10 shares at $3. And the red dotted lines represent the holdings of the person, so what they own like on paper, whereas the blue and the green lines represent their position. So as soon as a trade occurs, your position immediately adjusts to reflect that. So once you buy 5 shares, your position in that asset rises. And when you sell 10 shares, it your position in that asset becomes negative. And then after some amount of time, the trades settle and the holdings converge and match the position. Okay, so here's the first result. Your exposure and P&L is determined entirely by your position. And this is because the terms of the trade are locked in immediately upon trade execution. And so you might as well believe that the transfer of assets and money are occurring immediately. So for example, let's say you execute a trade to buy Apple at $30. Immediately you are exposed to the movements of the Apple stock price. So if the market price immediately goes down to $10, you are still paying $30 for it upon settlement, but might end up having to sell it away for $10. So you're immediately exposed to the risk as a result of your position. And due to this result, for trading games and simulations, we can abstract away all the messy post-trade lifecycle settlement stuff and just consider our assets and cash position and disregard holdings entirely. Okay. What's an exchange? An exchange is a centralized venue for participants to find willing counterparties to make trades with. And if a trade does not occur on an exchange, then the trade is over the counter. We'll only discuss exchange trades during this workshop. So examples of some exchanges are listed below. We've got the US exchanges, we've got the APAC exchanges. So yeah, let's move on. Okay, so it would be pretty inconvenient if each person had to individually accept each trade as it came in. So imagine Bob sent Alice and Charlie trade requests, and then each of them has to accept all of their incoming trade requests, and everyone's talking to each other, and it gets really messy. So we sort of want a more elegant, nicer way to let people agree to trades. And so the way we do this is by using the concept of limit orders. So each participant maintains a set of these items called limit orders, which the exchange uses to automatically infer whether they would agree to any hypothetical trade or not. So this is what a limit order may look like. So Alice tells the exchange, I'm willing to sell a maximum of 5 Apple shares, and I'm willing to sell each share at a price of $30 or better. And the act of telling the exchange this is called inserting a limit order. So here in this diagram, we have the prices in the gray bar in the middle. We have the volume, the quantity in this limit order in the green box. And the green arrow on the side, the green line on the arrow, just represents the range of prices at which Alice is willing to sell each Apple share. Okay, so by submitting the sell order, Alice essentially authorizes the exchange to accept trades on her behalf until 5 Apple shares have been sold. And once this happens, the order is considered filled. So this basically makes it so that Alice doesn't need to individually accept each trade. The exchange can infer, based on Alice's order, whether or not she'd agree to a certain trade. And there's 2 different types of orders. There's a buy order, also known as a bid, which expresses a willingness to buy. And there's sell orders, also known as offers or asks, and those express a willingness to sell. So the bid is on the left side. It's the willingness to buy 10 Apple shares at a price of 28 or below. And we have Alice's original offer, 30. Okay, so on the exchange, there are many participants. That's the point of an exchange. So in this example, we have Alice, who's green, Bob is red, and Charlie is blue. And the exchange keeps track of each participant's open orders. So open orders are unfilled orders. and collects them into an order book, and that is displayed in this diagram. So we have two sides of the order book. On the left side, we have all the buy orders, and on the right side, we have all the sell orders. And to all the volumes or the quantities of each order are written within each of the colored boxes. Yep. And they're also placed in a certain order. So the closer towards the middle of the order book you go, that means that the trade had that represents the front of the queue. So towards the middle is the front of the queue, and towards the outside is the back of the queue. So essentially on each level, on each side, there is a queue of open orders. Okay. So two limit orders are in cross if one is a bid and the other is an ask, and they belong to different people. If one order is a bid and the other is an ask, and also if there exists an intersection between the price ranges that they are willing to trade at. So essentially, if there exists a bid that is above an ask, then we have an intersection of ranges that they're willing to trade at. So if you look at the blue line and arrow and the green line and arrow, if you combine them together and take the intersection, you get yellow line. Right. And the exchange could execute a trade between these two participants at any price within the intersection. So we're going to move into the specifics of how exactly orders are matched with other orders and how the correct trades are determined. So if you can, could you guys just take a photo of this quickly, and we're gonna be referring back to it over the next couple of slides.
Really great one of them.
Here's one of them. Oh yeah, could you do that? Yeah. Looks so fishy. All right, so consider the following order book state. So remember that Alex is green, Bob is red, Charlie is blue. And we have all the bids on the left side, all the offers on the right side. And let's say Charlie decides to insert a bid for 15 lots of Apple at a competitive price of $30. So first, what happens is that the exchange, okay, so first of all, yeah, orders are inserted one by one, so there's no like concurrency or anything going on. So we're handling Charlie and only Charlie's order at the moment. So first we find all the orders it's in cross with, and then we apply the price time priority rules. So we start matching Charlie's orders against, firstly, the most competitive offers. And if there are multiple competitive offers, we use the time priority, which takes from the front of the queue. So first, Charlie's inserted order gets matched against Alice's bid, which is highlighted in red, and a trade is executed. So Charlie buys 5 shares from Alice at $30. That trade gets executed immediately. So let's rewind a bit. We can also see that once this trade occurs, the volume of Charlie's inserted bid goes from 15 down to 10. So it's sort of cancelled out with Alice's offer at 30. And we keep doing this at the front of the queue. So now Charlie buys 3 shares from Bob, and now he's going to buy 3 shares from Alice again. And now those 3 trades have been executed. And there's still remaining orders in cross, so we're going to deal with that one. And now Charlie's bid order has run out of volume. And so according to our rules, Charlie's order is filled and now discarded, and therefore this is the final state of the order book. And these 4 trades have been made. And those 4 trades will reflect immediately in the participants' positions. So that's our first order book insertion example. Here's another one where we have a larger buy order, this time for 50 lots of Apple. So, okay, those are in 5 orders and cross, and we're going to deal them in price time priority order. So, bang, a trade, another trade, another trade, and finally, there's no more trades in cross left. And so the rules say that Charlie's order is going to get inserted or like placed into the order book at the level that it was inserted, like that. So this is the final state of the order book, and those 5 trades have been executed. Okay, so that's it for our examples. So what do participants actually see? So the actual order book is kept private usually on the exchange, and exchanges only reveal to the participants the set of their own open orders and the aggregated order book, which is where all the quantities on each level are aggregated and anonymized. So this is, on the right side, we have Alice's view of the order book. So Alice can see her own orders, and she can also see like combined volumes of orders in the order book, but she doesn't know like where each participant is, where each other participant has orders at. And yeah, that just keeps keeps trading fair. Okay, let's define some more terms. An order book with tight spreads and large volumes is considered liquid. So in general, liquidity is just how easy it is to buy or sell a share without moving the price a lot. So in an illiquid market, orders can eat through the order book, and this is called market impact. And it occurs when an action has a significant effect on the market price. So initially, we have an example of an illiquid order book. Can anyone tell me why it is considered illiquid?
Yep, there's no crossing.
Not what I was looking for. So tight spreads. Here, the spread between the best bid and the best offer is like pretty small, so it's not about the size of the spread. Yep.
Small volume.
Yep, exactly. The volumes of the orders in the order book are really small, and therefore any large enough inserted order is going to immediately eat through all those prices and change the market price significantly. Okay, so we're going to go through some discussion questions, so feel free to participate. What trades occur when Charlie inserts the offer at 29? So have a look and a think about it. Oh yeah, see it?
13 shares are filled out 29. 3 offs. Shares are filled out 30.
I can't you.
13 shares are filled out 29.
13. So it doesn't sound right to me.
9 shares are bought at 30, then
Yeah.
you take away, you do 6 at 29, so you'll end up buying
Yeah. 9 shares at 30
30
and
and then 6 shares at 29.
6 and 29.
The highest buy price is to 29, 6 units at 29. 7 units at 29.
Okay, so you're right, 9 at 30 and 6 at 29, but trades are defined by like who buys and who sells. So like who exactly is
Oh,
Charlie
Charlie
selling?
Finance. And I guess the
Sounds right. So first Charlie sells to Bob for 4 lots, then sells to Alice for 5 lots at 30 for the 30s. And then finally Charlie is gonna sell to Alice at 29 for 6 lots. So how does each person's position change, like before and after? So let's say Charlie starts with 0 cash and a 0 position, and let's say that cash and asset positions can go negative as well. Where does Charlie end up after? Where does Alice, Bob, and Charlie? Where do they all end up after this trade has been dealt with by the exchange? So, firstly with Charlie's position.
For Charlie, his cash would go down by 15 shares, or whatever the shares is. But his assets would go up by, oh wait, he's selling.
He's selling.
Okay, sorry. His shares will go down by 15. His cash will go up by 15 times whatever the value of the share is.
So what is the value of the share?
29. So that's 29. That will be 431.
So not all 15 of the shares were executed at the price of 29.
Oh, right. So
Some of them, like the first 9, executed at 30.
that's right.
And then the remaining 6 executed
Yeah,
at
my bad.
Yeah. So it's going to be 9 times 30 plus
1 to 14. His cash position goes up 1%.
I can't do mental math.
Let's see. You're right. 144.
Yeah, something like that.
Oh, she knows.
Okay, how about Alice's position before and after?
Oh, ridiculous.
What?
Alice's shares will go up
That would be fine.
by 15, but she will lose 150 plus.
No, it won't go up by 50%. Because anyone else can answer?
I'll lose his 15 shares, next to cost. Gain 440
Alice is buying.
yeah.
Yeah, so her position in the share should go up.
It's not a contest.
So Alice is given 5 shares at 30 and that's number 6 at 50.
Yeah,
So she gets 100.
29.
yeah, perfect. What about Bob? Anyone want to have a Bob's position? Someone
That's why it's only.
who you have the other.
Yes, 4 shares.
Yep, and that's all.
Yep.
For the size goes down by 4 times 30. Right, looks good. What does the order book look like after this has been handled? I'll just answer this one. So the 2 orders at the price level 30 are going to be filled, so they're going to be removed. And then Alice's bid for 10, they're going to be reduced to a bid for 4, because 6 gets executed against Charlie's order. And then Charlie's order is going to be filled and it's going to be discarded because it ran out of volume. Okay, last question. It's more, I guess, subjective, but how do you think Charlie's opinion about the true price of the asset differs from Alice's and Bob's opinion?
The asset is overvalued.
Yep. Charlie thinks that the asset is overvalued, so essentially he wants to sell, get rid of it. And you can tell by each participant's bid ask spread. So as you can see, Alice's best bid is at 30 and her best offer is at 4, and it's basically hovering around 31, whereas Charlie's bid ask spread is hovering around 28. So essentially Charlie believes that the asset is overvalued and wants to sell at a price that he considers good for him. Right. Any last questions before we move on to discussion of trading games? Yep.
If Charlie wants to sell at 29 and Bob wants to buy it at 30, what's the final price of that? 29.
So one of the rules is that if there's an aggressive order and there's a passive order, it's executed as the passive order's price. So since Charlie's order is getting inserted, Charlie's order is the aggressive order, and Bob's order is passive and it's at 30, so it gets executed at 30. Any other questions?
Yeah, say I was Bob here and I see Charlie selling aggressively like 15 share per hour. So should I be scared as I was before? Is there an argument to be made?
Yeah, like how does it Bob see Charlie selling aggressively? Should they be scared? Like, does Charlie know something that they know?
Yes, insider trading.
Yeah.
Like small.
That could be possible, yeah. Right.
I wouldn't use something.
Ready to take over trading games?
Yeah, sure. Okay, what are trading games? With a trading game, we have players, and these players trade a stock whose true value is unknown to them. So this might be some figure, for example, the volume of Burj Khalifa, for example. It is a known value, but none of the players really know the exact value. Everyone starts with equal cash and position. Typically, this is 0 and 0. Players then bid and asks, which get matched by the engine. Partial information about the true value is going to be released over rounds. And the main objective for the players is to update their estimates and trade accordingly to this new information. At the end of the game, the true value is realized and all positions are liquidated at the price. And your score or your final position will be the cash plus your position times the true value. So an example is value of the stock we're trading is going to be the volume of the tallest building in the world. At the start, we might have no information, and players can make their markets and trade according to these markets. But as the game goes on, extra information is revealed. For example, the height of the building is 828 meters. Which players adjust their estimates and trade accordingly. After a couple minutes, maybe we get revealed that the base area is 8,000 meters squared. The players refine the estimates again. And at the very end of the game, the true volume is revealed and the positions are liquidated. There are a few ways to play trading games. The easiest one is open outcry, where everyone just shouts their bid and offers and shouts what trade they want to make. And we manually track these positions on paper. Another way is to play on a simulated exchange online. And this is often neater, nicer, no mistakes. Why we care about trading games? We care for, three main reasons. Most importantly, we build intuition for these markets, order books, and spreads. We'll often find that at trading internships, the traders, they play a lot of these trading games to just gain a better intuition for how to trade. We improve our estimation and mental math skills, and sometimes these trading games may appear in one form or another in the interviews at some trading firms. All right. Any questions about trading games so far? Okay. So I reckon we can have a go at a trading game here. We're going to be doing open outcry. And up here are the rules. So what we're gonna do, or typically how it works, is people just shout their trades or bids or offers. But because we have so many people here, I reckon it's better if we raise our hands, we have a trade, so it doesn't get too messy. And I might call on someone for them to make their trade. There are a couple things you can do. So you can say bid X, which means you want to buy at X. You can say offer X, which means you want to sell at X. Or you can do both, right? Bid at offer, which means you want to buy at your bid and sell at your offer, right? And for these first three, just to clarify, these first three doesn't mean that you make the trade. It just means you broadcast your willingness to trade at that price. If you want to take a trade, you can say yours. So you sell your asset to the bid, or you can say mine, which means you can buy your asset, buy the asset at the lowest offer. Any questions so far? I know this is pretty simple, very brief, but I think it will make a bit more sense as we go through it. Okay. All right. Let's say the market is going to be the number of 7-Elevens in Tokyo. Okay. So don't search this up because that will ruin the entire point of the trading game. Right. If you search it up, you're banned. But yeah, number of 7-Elevens in Tokyo. Is anyone willing to make an initial market? So all that means is provide a bid and an offer.
Do we do it in thousands or like little just
Maybe we can do it in hundreds.
100?
Anyone? It's okay. Don't be shy.
200.
Sorry?
200.
What does 200 mean?
Is it your bid or your offer?
Bid 200. So is that 200, 100? Or just 200?
200.
200. Okay.
Yeah. Bid
Yeah. So that's bid 2 because we're going to be trading in hundreds. Okay.
Okay.
Yeah. Bid 2. Anyone have an offer? Yeah.
Bid 2.
Oh, bid 2. Bid 2 is already said. So if you want to raise the bid, or if you can only improve the bid, which means I can say bid 3, bid 4, but you can't lower it or keep it at the same value.
Who bid to? What's your name?
One.
One. Can you give your initials? H.
J.
J.
Okay. Yeah.
Bid 4.
Bid 4.
Bid 4, right? What's your name, sir?
Daniel.
Daniel. And just to be clear, we're trading at one volume. So all these trades are at a single volume.
Bid 5.
Bid
Bid
5.
5,
We've got a few more coming in. Bid 6.
6.
Can you do better?
Offer 50.
Offer 50.
Right.
I sell at 50.
You sell at 50.
Yes.
So
So you're offering 50?
I'm offering 50, yes.
Well, you have to.
we have
You
the
have to
offer at
beat
50
the
already.
current offer at 50.
Oh.
You'll be going down.
It's going down.
Yeah, we don't wanna if you wanna improve the offer, you can only go down.
Oh, okay.
Right. So yeah.
Offer 15.
Sorry?
15 offers.
Offer 15. Right.
So that trade's executed.
What trade gets executed?
Oh, no,
No.
he was, oh, he's
There have to be a
surplus.
surplus.
Okay. Yeah.
Sorry?
In the grade?
Can you even
So
unfreeze? Oh no, we got.
Zidian buys at 15.
Yeah.
Right, so this trade gets executed. So keep track of your volume.
Who was that?
Zidian. My boy Zidian.
Was it?
Yeah. So Zidian bought at 15, so his position's +1. Who had the offer 15?
Oh, wait. Wait.
Oh, who?
Q.
Who had 15? Oh, who had the
Bought it
offer?
from me.
So what was that, sir?
Well, he bought it from me, right?
Oh, so you had the offer? Yeah, so your position is now -1. So +1, -1.
Alright.
So just keep track of -1. So your position's -1, and you bought at 15. Is that right? Yeah.
Yeah,
so
so
write that
Zidian-
down somewhere.
Yeah, Zidian bought at 15, you sold at 15.
I'll offer 14.
Offer 14, so that's offer decrease. Yeah.
Bid 11.
Bid 11? Yeah.
Bid 14.
Bid 14. So now there's an offer at 14, bid at 14, so this trade gets executed. So you bought at 14, and who had an offer at 14? Yep, so now you sold at 14, so you guys traded. Okay, so that's a few trades. I reckon we can release some information now. Do you have a phone? I think there's something like that.
Yeah. So are these all offers here? For all bids?
I think how it works, or if we write them up.
If it's
Yeah, bids office on that side. Maybe just
What do you want subjects? Population of Japan.
oh, that's not very informational, but I reckon. What about number of family lots in Japan?
Oh, that's
McDonald's.
huh?
Number of McDonald's.
Number of McDonald's. Yeah, family moth is a bit too similar.
Yeah, fair enough. Okay.
Yeah. There's actually no.
No information.
Oh, okay, that's what it is. Almost that big in Japan.
Okay. So new information came in.
Newsflash.
Feel free to adjust your markets. So the number of McDonald's in Japan, so all of Japan, not just Tokyo, but all of Japan is 3,000. So use that information if you want.
Alright, I got some offers here, yeah?
Offer 13.
For 13.
Yep.
For 11, but all my other.
For your other offer, okay. Offer 11.
What's the original offer at?
Just do a tally, don't do people.
It's where is it?
Yeah, who had the bid at 11? Yep, so you guys trade, keep track of your positions.
So you're plus one to your position.
Yep.
Oh, bid 13.
Bid 13. So another trade executed.
Oh no.
Are we keeping track of our positions here? Yes.
Okay, I think you were you first? I can't remember. Yep.
Sure, bid at 13.
Bid at 13, okay. In the black.
Offer 13.
Sure, offer 13, okay. Trade. Yeah.
Down.
Bid 12. Yeah. Bid, so the bid's already at 12, so I don't think we want to decrease, just to make it simple, right? We only want to increase the bid. Yeah. In the white,
Offer 15.
offer 15.
And you said you can't bid 12.
Offer 13 again.
Offer 13. Okay. So I think the market settled around 13.
Should I release some information? Also,
Let's release some new information today.
how about by information if I start trading?
Oh, you start trading. Okay. So,
There's an informed market maker / informed trader here.
yep, so Kevin,
And I'm looking. So who's 13? Mine. Who's 15? Mine.
okay, Kevin buys everything. What do we think about that? What should we do?
I'm holding, bro. I'm holding.
Alright, any new trades? Any new offers? Any new bids? Yeah.
Plus one.
Bid 20. Bid 20.
Mine.
Yeah.
Offer
20.
Offer 20. Yeah. Okay.
Offer 25.
Offer.
I'm running out of space. Should I shift everything down?
Okay, no, let's just write let's just write the best bid and best offer.
Yeah, let's we can get rid of some of those.
Yes, we're going to get rid of the multi-levels, and from now on, we're just going to keep track of the best bid and the best offer.
Sounds like it's that trend.
So we're going to get rid of the multiple and just keep track of what.
So I heard what was it offer at 20? I can't remember. Offer at 25? Okay, so best offers at 25, there is no bid currently, I think. Sorry, you said best offers at 20? Okay.
25.
Best offer at 25? You want to decrease the offer, right? So offer at 25 is actually worse. Right. 19, offer at 19? Yeah.
Bid 19.
Bid 19, so that's a trade. Right. You two trade, track of positions. Yeah. Bid 20, another trade. Or yeah.
Offer 21.
Offer 21.
Bid 21.
Bid 21, another trade.
Okay, cool. So my cash position is plus 7.
Should we release some more information?
Yeah, yeah. That's,
What do you want to release?
I don't know. Think are they on track?
Hold on a sec. You're going to release some new information.
So what do you want to release?
What's very helpful? Like, do we just want to close it? This is the final round.
Awesome.
Bid 2.
So,
I want to give some like juicy information.
So like, okay, so what can we talk about? So what? So it's
Okay, let's release this. Maybe?
When you guys are not just working,
wait, let's see.
Only like the difference between token and soccer, like the difference on automatic.
Yeah, okay. We can do that.
Canvas should be plus a big inserting for long. Report columns. Wait, it can sound big.
Right, we're going to release some new information here. Tokyo has the highest number of stores compared to other Japanese prefectures, such as Kanagawa. Kanagawa has 1,500, so that would be 15. And Tokyo has the highest amount. Now I'll also give you the population of Kanagawa. Does anyone want to make an offer or bid based on that information so far?
Of the 17.
Kanagawa Prefecture has approximately 9.2 to 9.3 million people.
Yep, in the white.
Offer 7.
Offer a 17. Yep.
White.
16, bit 16.
Right.
Oh, wait, this one said mine?
Yeah.
Okay.
Okay, so someone said mine at students.
Okay.
Where no. So that's great. There was mine is when you want to execute against the side.
About 17. So 1 of 17.
Someone's bid it at 17 before. Wait. Were you the one who said bid at 17?
No, someone said offer 17. I said, oh, mine.
Okay, sure, quickly.
Yep. So Kanagawa Prefecture has 9 million people approximately. Tokyo has 37 million people approximately. And Kanagawa has 1,500.
Okay, in the white, bid 18. Yep.
Bid 20.
Bid 20.
Offer 25.
Offer 25. Cool.
What?
I think he said bid 25 first. So bid 25, 25 trades. Yep.
Offer 20.
Offer 29.
Oh, 29.
Yep. Take that. Right, 29 trades. Offer 35.
Offer 50.
Offer 50.
Your offer needs to be better than the best offer right now, so it needs to be below you. Because someone's competing against you.
Bid 25.
Bid 25.
Offer 30.
Right. Offer decreases to 30. In the back. Offer 25. Okay, so that trades with a bid.
Bid 30.
Bid 30. Right, so that trades with an offer as well, I think.
Offer
Okay.
30.
Offer 30. So 30 comes back.
Offer 29.
Fine.
Oh, who said mine first?
Who said mine first?
Wait, I think the front said it first. Alright.
Yeah, but I'm closest. Thank you.
Oh, I guess so.
Offer 29.
Offer 29.
Offer 28.
28.
29. Fine.
Bid 29. Okay, so that trades. Okay, let's bid 25. Let's do like a couple more trades and we can wrap it up.
Offer 26.
Offer goes 26.
Fine. Slow. Bit slow.
Bid 26.
Bid 26.
Offer 28. Fine.
Okay, 28 trades.
Market's not settled yet. I feel like we're still trading a lot.
Bid 27.
Hey.
Yeah, bid 27.
What was 27?
Bid 27.
Bid 27.
Offer 28.
Offer 28.
Fine.
Oh, that was tight. Alright, 28 trades.
Offer 27.
Offers at 27.
Fine. Offer 28. Fine.
Okay, 27, 28 both trade. Yep.
Offer 29.
Offer 29.
Offer 28. Mine.
Okay, 28 trades.
Offer 28 again. Mine.
Okay, that trades again.
Offer 29.
Offer
Office at 29.
It's already up.
offer 29. What offer?
Offer 28.
Okay, 28 shares.
Okay. We're gonna close the market in 5 seconds here. Any final offers? 5.
28. 24. 9.
28. Are you offering or bidding?
Offer 28. Okay.
5.
Offer 27. 27. 7.
27.
9.
Okay.
So
last
28.
okay, market's closed. Market's closed.
All right. Does everyone remember their positions?
Yes.
How about the cash? How much you bought for? How much you sold for?
Yep.
All tracked?
Yeah.
Okay. So we're going to release the actual value now, which is
Mid 2025, there are approximately 2,916 711 Tokyos. So that's 29. So that's pretty close.
okay. So 29. So everyone calculate the final cash position.
If you are buying below 29, that means you made money. Yeah.
Yeah.
Unless you just held it, then you sell it.
That's correct.
Yeah.
Well, what happens to asset position in the
It gets liquidated. So
Oh,
everything turns into 29.
Everything to
It will
Yeah. All right. Who had a positive PNR? Wow, I love you. Okay, who had a negative PNR? 3 people, a lot, or 4 people, a lot less. Okay. So yeah, that's just a sample of what a trading game is. If you do any internships or maybe even interviews, you'll see quite a few of these. But yeah, that's just the gist of that.
Kevin.
Okay.
Yeah.
Sorry.
Hope you guys enjoyed that. That was super fun. That's a good old example of what open outcry is like in trading. We were just trading on this imaginary instrument, which was the number of settlers Tokyo by the hundreds. But really, when you're trading the markets, you can trade any sort of instrument. So an instrument is a tradable financial asset or contract. So commonly you'll see equity like stocks. You also have fixed income securities, which is anything to do with debt. But also derivative contracts, derivatives on commodities, options, swaps, foreign exchange, and also pool investments, so like ETFs. And some of the types of firms that you see will be participating. The first one being proprietary trading firms. The idea of proprietary trading is the firm uses its own money or its own capital to trade the markets. Does anyone see like a benefit of using your own money to trade? You get to keep all of it. You guys keep all of it?
People come to us.
People can't go out or yeah.
You guys like doing fun. Like, you guys doing fun.
You guys do what you want, yeah, that's a good argument as well.
Yeah, the risk is lower, but
Your risk is lower. I'm not going best it lowers your risk. I guess you can take more risk, is maybe what you're trying to say, because the next kind of contrary point is would be hedge funds, where you are trading money from your outside investors. Say you take a lot of risk as a hedge fund, and suddenly you lose a lot of money. What do you think your investor does? I want my money back, right? If you guys have watched The Big Short, the big quant movie, you will notice a big recurring theme that is shorting the US housing market. There was a lot of backlash from investors because they thought this was a ridiculous position to take. So while prop trading firms, yes, you get to risk your own capital and you get more leverage with that, it's also a double-edged sword as well. Hedge funds are generally a bit more principled in how they trade. They won't take as much risk. Short positions being one of them. And some of those examples, for example, for private trading firms, you see Oxford, Jane Street, IMT Trading, Susquehanna. Hedge funds, you see Citadel, or Citadel Securities, Citadel, Two Sigma, D Shore, and Q. We also see banks getting involved in quant law. Banks don't have such a big trading aspect as hedge funds and trading firms, but they will often use quants, often called strats. And their job is to price products and essentially run these trading desks. So a good example of that would be Goldman Sachs and JP Morgan. And finally, you also have asset managers. So these are people who manage huge loads of money across the entire world, talking trillions of dollars. And they take this money from retirement funds and ETFs, etc. Their goal is to focus more on long-term growth. So usually they won't be involved so much in short-term trading. And you'll see this in BlackRock and Vanguard. We talked earlier about trading on an exchange. But does the exchange actually get anything from this? And the answer is yes. The exchanges make money by charging a small fee per trade. So if any of you guys have traded by yourselves in the markets, you would have noticed that when you place order, maybe after a certain amount of order volume, that might incur a small fee that goes to exchange. And so the exchanges, their business model is to get as much trading volume as possible to get their own money up. And to attract customers, they want to provide a fair and transparent trading environment and also maintain high liquidity by attracting market makers. So what's a market maker? Before we were trading against each other, but a market maker works as someone who comes into the market and provides liquidity by continuously quoting buy and sell prices. So earlier you might have put in a bid for 14 or an offer at 28. A market maker would come in and offer both. They would say, I'm 14 at 28. And then they would make money based on the spread between 14 and 28. So someone might sell to them at 14 and might buy from them at 28. So that's what they do. And they often have a good relationship with exchange because exchanges need the liquidity that market makers provide. So some of the stuff they do, quote a minimum size at all times, quote within a certain spread, and don't do any manipulative trade. And exchange, they get good rewards like fee rebates or getting blacklists. Can anyone have a guess as a market maker? Do you want your spread to be tight or wide? Hands up for tight. Hands up for wide. Hands up if you don't know. You want your spread to be wide, and that's because if people are buying from you down here and selling from you up here, the larger your spread is, the more you're going to make. Now, this comes with a caveat that if a market maker sees you with a very large spread, they probably want to compete with you by making an even tighter spread. And so, yes, the people who put their hands up and said, "Oh, we want your spread to be tight," that's technically true if you want to be competitive as well. But most of the trading these days is done by automated trading. In fact, in the US market, I think it's about 80 to 90% of all trading volume. Programs often run code and algorithms on machines that directly pull information from the exchange, and then they feed that into their algorithms and then put back in, insert, delete, and amend offers from the exchange. Can anyone think about why it would be a bad idea to do all your trading from human traders? Yes. It's slow, yes. So the human reaction time is about 200 milliseconds. Computers are a lot faster than that. Make mistakes. Humans make mistakes. If I have a bad poker night before I go back to work, and I decide to go tilt and I start trading, my firm might find that I lose a lot of money that day. So yes, humans make mistakes.
Bias, the words one.
They might be biased as well. Yeah, that's right. So as humans, we inherently have a lot of bias in everything we do and how we think, and that's going to influence our market. At the same time, though, being biased is good because we have traders still trading today, and they have a good bias sometimes. They have bias that nudges them towards the more accurate pricing of it. And so this leads us to our next point of high frequency trading. HFT uses low latency infrastructure to quickly react to changing market conditions within micros. How a firm would often set up high frequency trading is they use something called co-location. This is when you place your servers as close as physically possible to the exchange. So if I have a server, or if I have an exchange, the New York Stock Exchange, and I'm trading across the Hudson River at New Jersey, there is a latency between me sending my order and the order actually arriving on the New York Stock Exchange. Co-location is trying to mitigate that by placing the orders or placing the servers as close as possible. And yes, by having low latency, you can react faster and mitigate adverse selection. And this is when your competitor or the other person on the other side of the exchange has some information that you don't and is willing to make profit off you. We talked about hedge funds before, but hedge funds are an investment management firm that hold investors' money. So it's one thing that an investment management firm will do is they take a fee for managing all this money. And so we go through this long list of hedge funds, but there's quite a lot of them. Q, we mentioned before, but also Antipodes, Hyperion, Plato, etc. Before, when you guys were trading, we were kind of simulating a more buy-side environment where one person takes an opinion and you want to trade or buy or sell assets. For the sell side would be the market makers. Those are the people who provide the services that enable trading, most notably providing a spread. And to categorize these a bit further, the people who are on your buy side are trying to invest, speculate, or manage risk. So that would be your asset managers, hedge funds, corporations, and retail investors. For your sell side, you have your brokers, your dealers and market makers, as we mentioned before, but also some research and investment banking. These guys are all trying to provide trading services and make a profit with that. Okay, let's talk about some roles of trading.
Right, I'm going to be talking about the roles of trading. Roughly, there are traders, researchers, and developers, although from company to company, it's going to differ on what the definition of the role is and also how broad the scope is. But roughly, they fall into these categories. So a trader is the person making the decisions, and they fall into either like systematic or manual traders or somewhere in between. A systematic trader would be adjusting the strategy to make the trading outcomes, whereas a manual trader will be more in touch with exactly what the strategy is doing and have a finer control over it. For example, in options trading, there's a concept of a Volksmarkt, which is a way to express your opinion on the prices. And so a trader might be bid for, meaning that they want to increase the pricing a bit. And in this way, they're controlling a very manual part about how trading happens. Note that they aren't doing the trading manually, like doing the actual trades, because as before, doing those trades are gonna require reaction time, and that will be slow. Traders also write scripts. These can help them to test strategies, although more complicated scripts will be left up to researchers and developers. Traders might have a morning meeting to describe what's happening overnight. Maybe if the desk is a 24-hour desk, you will have positions which you want to wind out of, what positions you want to hold. And they will also be updated on any news that happens, especially in Australia. If American news affects what's happening, you want to know that before the day of trading starts. In a trading interview, and especially the technical interview, there's going to be these topics. In mental maths, if you've heard of DataMag, it's a way to practice your mental arithmetic. Although this is helpful, it's not completely necessary. But again, it depends on what role you're applying for. Perhaps like in a manual trading role, you would need this more. Whereas in a systematic role, the trading interview would just be testing for your quick thinking rather than a quick arithmetic operations. Most prominently will be probability and combinatorics questions, which someone will be going through later. this will test like how fast you can think about new situation and how fast you can pivot given new information from the interviewer. Sometimes you're asked to quote like your confidence interval of like, do you think that your answer to the probability question is correct or not? But you can also be given a scenario like maybe you're trading some product, imaginary product, and you're asked how you're going to be trading this and what your confidence interval is about maybe its fair price. And in these things, you'll be assessing like how comfortable you are with dealing with these things in a high pressure environment and how good you are at dealing with new information and how confident you are at financial market related things. In some roles, you will be required to know statistics, libraries in Python like NumPy, Pandas, and like plotting libraries. This would be more for a more systematic role. Researchers are quite tied into the role of trading, but they analyze the things that happen behind the scenes. Roughly, they fall into three categories, being analyzing your past trades to determine like maybe your trades are not being as profitable as you expect them to be, and so you need to find a way to improve your execution. Or maybe you find your trades are doing like way better than you think they are, in which case maybe you're not accounting for your numbers correctly. The second type of work that you might be doing is looking at pricing. Roughly, an alpha or like your signal is going to inform you about your opinionated price. And if this differs from your actual price, maybe it's a bit higher or it's a bit lower, you would want to buy or sell. But to figure out what your opinionated price should be, you need to look at past data and perhaps think about the maths of it. It can be interesting if you're pricing exotics, which are non-standard products. And since these don't have like known pricing models, there's an opportunity to make more models to do this. And the third category of what you could be doing is execution. So once you have some alpha or some opinionated price, you want to be making trades based on this to realize the difference between your opinion and what the market is pricing it at. And this involves like placing some orders, getting into some position, and then getting out of that position again. And so how you interact with the exchange and with what speed you do this really matters. And in this, you might look at how your trades are interacting with other market participant trades, like whether you're getting it faster, and ways to interact with the exchange faster. I forgot the last point, but that's basically talking about if you're trying to find signals when pricing ETFs or correlated products, you may look at a covariance matrix as part of the signal. But there's many ways to make signals. And in this, in the technical interview for this, you may mainly be assessed on probability and statistics. This would be like your knowledge of like basic stats concepts, models, machine learning, time series analysis. But overall, they're just looking at how confident you are and whether you account for all sorts of assumptions. Another way they could assess this is with a take-home project. This would be along the lines of like, here's some like real or fake data, and maybe find a signal and explain how you came up with this, and explain a good methodology for like finding it and also testing that it's valid. In engineering roles, it's roughly just software developer, but you could be leaning more towards like a quant dev, which would be helping to write the strategies, or hardware, which is more looking at hardware, I guess. Within software, they are making like all the systems required for trading. It could be things like the order engine, the UI, how you settle trades, maybe even looking at how to deal with like recruiting and software with that, depending on how front office or back office it is. And depending on where you are sitting, like how close you are to the trading, you may care about latency. For example, if you are getting new information from the exchange, you want to react to it quickly in order to get your trade to the exchange first. And in this case, you'd be caring about bursts of information. And data throughput, if you're working with maybe back testing or data pipelining, and you're dealing with a huge amount of financial data. In the interview, you likely be assessed on data structures and algorithms. Maybe you'll be given a contrived comparative programming question and asked about how you think about it and what solutions you come up with. You may be asked about like how to design the system, and maybe there's some requirements, and maybe it needs to be extensible for future developers to continue building features on it, and ask how you think about that. Overall, just general knowledge about databases, networks, OS, and so on is helpful to be a good developer and may help a lot in the job, depending on how close your code is to that aspect. And I haven't heard about testing being assessed. Like maybe they'll ask a few quick questions about how you're going to test that the solution's correct. But usually I wouldn't expect them to ask you to write the unit test in an interview just because of the time constraints. So as I said, if you're working more maybe like an older engine, you'll be working in C++ or Java, working with like knowing how the compiler works and how it's going to optimize your whole path. Whereas if you're working more closely with the traders, you may be implementing their algorithms and you need to know some basic statistics and how to manipulate data in Python. Quantitative development is a mix between research and software. So I guess you need to know a bit about both skills, both some staff skills and some developer skills. And the interview process for any of these roles will roughly be in this form. When you first apply, you give the resume. You have an online assessment and a resume screen. And the behavior interview might not be second. That will just be your standard questions like why do you want this job? And yeah. In the technical interview, it depends on what it is, whether you're going for a more software developer or trader role. You may have probability questions or like software development, like technical questions. And they may or may not have a final round when they throw a bunch of interviews at you, but they all tend to be technical behavioral.
Okay, I think we're moving on to the example questions now. All right, so we're gonna move on to like two or so examples of questions they might ask you in a trading technical interview. So this is one we ripped off this random website, but yeah, have a read of it, and I'll give you guys like a couple minutes to try yourself and maybe discuss with the person next to you before we dive into hints and then the solution. Someone just sent it in the Discord chat, CPMSoc, and we'll just yeah. That's oh, so A1 on 1 factorial equals to 1, and you just keep adding like 1 plus half of this. Just add 1 plus 1 half plus a third up to 9, 10, and that's nice. Okay, this is version 2.1 of this. This version 2.1. Just count $8. $9, okay.
Really is, what is threat? It's all the points.
Does anyone have any first ideas on how to approach this? You may need a pen and paper to install this.
Should we try like assigning each car with like a rank of their speed, and then we explore like each combination of how the cars are ordered, and since they all have like an equal weight, we just look at how often certain combinations of the rank of the speed of the cars will end up in.
Yeah, that's one of the solutions.
Yeah, sounds good. Anyone else have any ideas?
Present.
Yeah.
Okay. Hopefully everyone has absorbed this question into their head. To hopefully understand what's going on here. Okay, so let's just say we have 4 cars for now. And instead of them all being in a line, we're going to graph them according to their speed. So the cars are labeled 1 to 4 from left to right, so that's their initial positions. And they're also each given an initial speed shown by the arrows. And below the graph, we see the ranks. So we're ranking each car by their speed. So just to like set up some notation, let's just say S sub n is the set of all n factorial possible rankings of these n cars. So this is one possible ranking, which is 1, 4, 2, 3, but there are like 4 factorial other rankings of this. And since the speeds of the cars are like IID, each ranking is an equally likely outcome. So this question, essentially, we can turn it into like a combinatorics question and just ditch the statistics side of it. And it turns out that the ranking completely determines K, which is the number of clusters. Can anyone tell me how many clusters eventually form in this particular scenario? 3. Yeah, 3 sounds right. So 4 is gonna move relative to 3 towards the right. So the distance between 3 and 4 is gonna keep increasing over time. So is the distance between 1 and 3. However, 2 is gonna end up crashing into 3. And so we're gonna end up with 3 clusters, one containing just 1, the other containing 2 and 3, and 4 as well. Okay. So there's going to be some word salad. So it's like I think just for some visual intuition, you can imagine like each of these cards having like a bar that goes from above it to infinity. And so if you draw lines from each card towards like in the direction that they're going, if your line like crashes into another card's bar, that means that there's a card in front of you that's going slower. And that means you're eventually going to crash into them and form a cluster with them. So in this case, the only bar that gets crashed into is 2 crashes into the vertical bar of 3, but then everything else makes it to the end like 1. And the final answer K is just the number of horizontal lines that eventually like reach the end without crashing into any bars. Okay, so on to the word salad. Okay, so let's say we have a ranking called sigma. So ranking is just like a list of numbers. For example, in this case, it's like 1, 4, 2, 3. But we're gonna define a function that maps the ranking to the number of clusters that results from that ranking. And let's just define A sub n to be the sum over all the rankings possible of f of the ranking. And that basically allows us to calculate the expectation of the number of clusters as the sum of the number of clusters for each ranking divided by total number of possible rankings. And yeah, that formula just comes from the fact that each ranking is equally likely. Okay, so now the problem becomes, can we find a formula for a sub n on n factorial, maybe? Are there any questions so far? Okay, so we can start from when n equals to 1. So when n equals to 1, there's only one possible ranking, which is just 1 by itself over here. And f of 1 is 1 because it's guaranteed to form one cluster because it's only a single car. When we move on to two cars, there's two scenarios. Either the left car is going faster, so the left car going faster, that's given the top ranking. And there's the case where there's a case where the right car is going faster, that's given by this ranking, 1, 2. So if the left car is going faster, it's definitely going to catch up to the right car, crash into it. So if you were to graph it, you have a car like this, speed, initial position, this car is going to crash into the car that's ahead of it. So it's going to form one cluster. Whereas if the left car is going slower than the right car, then no collisions happen, and we end up with two clusters. And so we just incrementally add one car at a time, each time deciding where to insert the fastest car. So every time we move on to a greater n, so n equals 2 to n equals 3, we insert the number 3, we can either insert it before, in the middle, or at the end. And eventually we see the pattern. And the pattern is that if we insert it anywhere that's not the end, the number of clusters is going to remain the same because the fast car is always going to crash into something. So the fast car will never contribute and create like a cluster of its own. Whereas if we put the fastest car at the end, the fast car is going to speed ahead in front of the previous case, and it's going to add to the number of clusters. Hopefully you guys get that. So our goal is to find a pattern for the sum of all these blue numbers in each column. So A of n, A of 1 is just 1, A of 2 is 1 plus 2, A of 3 is the sum of all these 6 numbers. And I want to create like a formula for this. And if you reason about it, you eventually find out that it satisfies this recurrent relation. One way to think about it is if we're trying to go from n equals 2 to n equals 3, firstly imagine that this is a 1 and this is a 2. Essentially, you're multiplying a n minus 1 by by n. So you're multiplying 2 by 3, splitting it into these 3 2s. We're multiplying 1 by 3, splitting it into these 3 1s. And then at the end, you're adding a 1 over here and a 1 over here to take into account the situation where we insert the fastest car here. And it turns out that the number of 1s we add is equal to like n minus 1 factorial. And then if you divide both sides by n factorial, we get this formula. And isn't it convenient that an on n factorial is like in the same form as the answer we want to compute? Okay. So we know that A1 on 1 factorial. A1 is 1, so if you divide it by 1 factorial, you get 1. So we can just start like building a sequence using this recurrence relation to calculate the value of each one of these terms. So A1 on 1 factorial is 1. A2 on 2 factorial is going to be our previous answer, which is 1, plus 1 and 2. And eventually you just build out the harmonic series up to n. But it turns out that the answer to our question is just the harmonic series up to 1 on 10. And there's an alternate solution as well. So this solution is like pretty messy and it took a while. So any other takers?
Just to go back to the question, make sure I have the right information. So we have dollars, and we want to find how many losses form. So we need to find how many calls don't get called up to, and we can do it, I think, by finding combinations of how many costs we get called up to over the total amount of combination multiplied by the amount of clusters for that scenario, and then you just sum all of that up. So it would be the expectation.
I don't think number of cars that don't get caught up to is the right interpretation. Because let me think of an example.
The next slide. What is the next slide a counterexample? This would be 3 clusters, right?
Yeah, 3 clusters. So wait. Let me think of this.
So your point is, or what you're trying to say is the number of cars that don't get caught up to.
Yeah,
is
so let's say there's one cluster, which means that every, like, it's like opposite. So the first one's the slowest, second one's second slowest. And there's one way that can happen, right? There's one way we can have one cluster with 10 cars. But then if you have an arrangement where only one car gets caught up to, there's 10 ways you can arrange that. But then if there's 3 cars that don't get caught off to, there's 10 choose 3 ways of arranging that. And over the total amount of ways you can arrange it,
seems
probability. It's like a peer, but you find the expectation using the CMS, then you should get it. You should just get it.
that sounds
It doesn't work.
intuitive.
Here's the counter example. So initial position, C. So the cars that don't get caught up to in this example are this. We have 5,
Wait,
whereas we form 4 clusters.
how does the one at the very start not catch up to the one immediately in front?
This is the speed axis, so this is going the slowest plus the speed axis.
Okay, so that's the slowest, so it never catches anyone.
Yeah. And that's represented by the fact that its line doesn't hit, it doesn't go above any of the cars.
Yeah, right.
So, good attempt. Okay, it's a pretty hard counterexample to find. Let's look at the solution that someone from CPMSoc gave me. So yeah, so this is the solution I came up with, but there's a more nicer solution. Yeah. So in all the top 2 dot points, it actually doesn't matter whether we assume it comes from a uniform or not. So just pretend those top 2 dot points aren't there. So consider the events for any k that, okay, first of all, let's define our random variables, x1 to xn. So we're numbering our cars from left to right, so car 1, 2, 3, 4, 5, 6. And we're going to let xk the speed of the K car. So for some K, what does it mean for xk to be larger than the minimum of all the cars that are, okay, what does it mean for xk to be larger than the minimum of all the cars that are ahead of it? It basically means that there exists some car ahead of it that has a speed that is less than the K car. Essentially meaning that eventually the K car is going to crash into that slow car that's ahead of it. Okay. So just to recap, BK is the event that the K car will eventually crash into some slow car ahead of it. And then let I sub k be the indicator variable for this event. So essentially it means that I sub k is equal to 0. So I sub k is a non-random variable. And it's equal to 0 if the K car does not crash into a slower car ahead of it. And it's equal to 1 if the K car crashes into a slower car ahead of it. And this is just something to note down. The expectation of this indicator variable is equal to probability that it's equal to 1, which is equal to that. Okay, so why would the probability that the indicator variable equal to 1 be equal to this? Anyone want to offer an explanation? Why is there an n minus k plus 1? Well, that's how many variables are involved in this expression over here. Yep.
It's like guessing, because it says in take to one is take so that's 1 minus. It doesn't crash into any cars.
Yeah.
And since it's so the interpretation for that is if it doesn't crash into any cars, then its speed is lower than all the cars.
Yeah, exactly.
And since x is a random uniform distribution that's gonna want to n, like 0 and 1, can like integrate back to get the zero, right? Because if you have like for example like
Sort of overcomplicated. So the idea is essentially just any permutation of car K and car N is like equally likely, right? Right. Maybe you're right. Someone else came up with the solution. Is he in this room right now? Probably not.
We'll have Brendan come back and debate with you and see if you can disprove that.
Yeah. So yeah, one thing about these example interview problems is that we sort of solve them on our own and haven't really checked them with anything yet. So maybe there's issues with it, but for now let's assume that this formula is correct. Okay, so another thing to notice is that each time a car crashes into a slower car ahead of it, the number of clusters decreases by 1. And yeah, that results in this formula. K, the number of clusters, is just n minus the number of crashes that occur. Because that indicator variable is 0 if that car doesn't crash into something ahead of it, and 1 if it is. So the summation term is essentially another way of saying the number of crashes. And then we just take an expectation and use linearity, and then reindex it, and yeah, we get the harmonic series again. So we got like the same answer using 2 methods. So I guess we're like 70% sure that this answer is correct. But I guess we still have to like figure out, why that probability is true. Maybe someone can offer a better explanation for this. Actually, I think it makes sense. Like each car in the range A to N has an equally likely chance of being the minimum. And so the probability that xk is the minimum out of all the other ones is exactly this 1 over the number of cars, which is 1 over n minus k plus 1. So yeah, single digit. Yeah.
For those who are more competitive programming and less trading or maths here, there's a very, very synonymous question, you combine one LeetCode or car fleet 2. So this is equivalent to LeetCode 1776. It's pretty much the same thing, but the idea is you're trying to count when each car will collide with the next car. Give you a bit of a hint, you can use some data structures like a stack to solve this.
Well, smart.
Suppose. Cool. Was it someone?
All right. Many love dice questions. So whereas the previous question was more of a just find the expected value, some other questions will ask you to find the optimal strategy in a given game. So yeah, maybe everyone can read this question and take 1 minute or two to think about a possible solution.
Does anyone have any initial thoughts about what a basic strategy would be? Are we playing a game or not? Should we play this game?
Yeah.
Yes? No? Why? Can you lose money playing this game?
No.
No. So you should probably play it. Yes? That's some basic strategy. Can anyone see like a pattern between playing this game once and playing it twice? And if there's some sort of recurrence, you can devise.
Well, one thing for sure is each roll, you have a 10% chance of like, losing all your game. The expected is 4.5. So like you're supposed to, I don't think like you're supposed to calculate like at how many rolls. Like, after a certain number of rolls, you have like lower and lower chance of not bankrupting. So you would find like the number of rolls.
Okay.
I would consider people to think of what they should do if they have a certain bankroll. For example, if I have $0, what should I do? If I have $10, what should I do? And so on. Well, I think the backwards first.
You treat it as like the expected value at a roll. It's like if you fail that roll, then you can treat the value of that action as losing everything. So it's like minus the expected value of K minus 1.
Yeah, that is a
Then if you succeed that roll, then the value you get is 1/10 times sine plus 8 plus 1 plus 1, which is like 4.5 or something.
it should be 1/9 times.
Oh yeah, 1/9.
But yeah, that 5. Yeah, that is a valid solution.
And then like the strategy in that is just you keep on rolling until your previous expected value is like too high, so that your like expected value now. Like, because the expected value at K Pro is like minus 1/10 of the expected value of the previous roll plus 5.
Right. So your strategy is to keep rolling until you roll like 5 times and stop. That's a potential strategy.
How many times? But I think you can like.
But just keep calculating your EV at your own. And then
45.
it's just like 5 minus your score times 0.1. Then if it's positive, you keep rolling, then you stop rolling.
Yeah, exactly. That is something you should do. And using that thought process, when should we stop?
When you use negative.
And what is that?
Is that 50?
Not 50.
How did you get 50?
14.5.
14.5.
It wouldn't be 44. Yeah, it'll be 45.
Right.
So, yeah, the first part of the question, what is the optimal strategy? You keep rolling until your bankroll is 45. At 45, you take a profit, right? And you'll find that there are really two strategies here. Either one, you roll X times, then you stop, or two, you roll until you have a bankroll of X, then you stop. I think the second one makes more logical sense. Like, you don't really want your strategy to build off how many rolls you've done so far, because that doesn't have too much, or that doesn't have a direct correlation to your P for your profit so far. To get the 45 number, there are quite a few ways to do it, I think. But one way I did it was at each step, you make a decision, right? You can either roll or not roll. And to find out which action is better or which one you should do, you just find the expected value of rolling versus not rolling. So the expected value of rolling is going to be, there's a 1/10 chance that you lose your money. So 1/10 times negative X. And then there's a 9 out of 10 chance you take someone, right? So in that case, your profit will be evenly distributed between 1 and 9. So how about the number 5 is you just add 1 to 9, then you divide by 9, and that will give you 5. So the expected value of rolling is negative X on 10 plus 4.5. The expected value of stopping is going to be 0, right? You don't gain or lose any money because you don't roll. And at the point where they are equal is going to be the equilibrium. So past that point, you want to stop rolling. Before that point, you want to keep rolling. So solving that equation gets you X equals to 45. Any questions here? All right. But the question had a second section. What is your expected payout following the strategy? Does anyone have an idea on how to do this?
Shouldn't your expected payout be the same as what we're going to stop at? Like, don't we expect to make? Like, that's why we stop.
Yeah, of course, right? So, we expect to get 45, but that doesn't mean we'll get there all the time, right? Sometimes we'll get 45, sometimes we'll get 0 because we roll the 0 because we go bankrupt, right? So it wouldn't be 45, it would be lower than that. Any thoughts?
Assuming we're doing the optimal strategy.
Yes, the optimal strategies.
I think you just add up all the possibilities.
And how would you do that? It's not an easy thing to do.
It's like you roll the 0 the first time, you roll 0 the second time, and it goes on. Oh, it's too many.
And can you do that on paper? No, it's like
6 to the power of.
no, I don't even know. We don't even know how many rolls to do, right? Any last comments, thoughts before we move on? Oh yeah, we can trade on this value as well if we wanted to. Any bids? Any offers? All right, very uncertain market. Okay, so yeah, it turns out that the exact EV requires you to do a Markov chain analysis. It's not very easy, right? You're not going to be expected to do a Markov chain calculation of this size. So that's why in certain questions, your interviewer may not be expecting an exact value. In this case, finding the exact value, which is 17.68, is really quite difficult. So we need to find some way to estimate this value. And this estimation must be doable on pen and paper without the requirement of a computer. There are, of course, many ways to do this, but one way could be, right, we first find the expected number of rolls before stopping. Again, this value is not easy to calculate. But an easy estimation is just to take the stoppage number, which is 45, and divide it by the expected value of the roll when you succeed, right? That'll be 45 over 5, which equals to 9. This is not an exact answer. The actual exact answer will again require Markov chains, but this is a good enough estimation for us. The probability of surviving 9 rolls is going to be equal to 9/10 to the power of 9. Right. And we also want to estimate this out. What we do is we can use the property that 1 minus 1 on n to the power of n is roughly equal to the power of -1. Honestly, I can't remember how this works, but it is a useful property. So in this case, our n is roughly equal to, our n is 10, right? So 9/10 to the power of 10 is equal to 0.37, roughly. And therefore, 9/10 to the power of 9 is going to be a little bigger than that. Right? So we can definitely estimate it to be 0.4. So to find the final expected value, we just take the probability of surviving 9 rolls multiplied by the payout when we survive 9 rolls. The answer is, of course, 0.4 times 45, which is roughly 18. And you can see it's quite similar to the actual answer given by the Markov chain simulation.
Yeah, and would you say like it's pretty impressive to get any estimation around like 15 to 20? That's like decent.
Yeah. As long as, honestly, the actual number at the end doesn't really matter too much. During the interview, they test your thought process throughout the whole thing. Right. In most interviews, they just really care about if you're intelligent, if you can analytically think about these problems, not whether or not you got the correct answer. Any questions? All right.
Yeah, thank you so much. Just a big round of applause to Jaden, Jeff, and Ryan. These guys spent a lot of effort and time putting into this presentation and also settling problems, so thank you very much. That brings us to the conclusion of the workshop today. If you want to dive a bit deeper, these are some of the resources that we've used today for trading, for probability and statistics, and also maths. So places.
Yeah, sure.
And also some of the sweet classics. So yeah, thank you so much.
Just some final notes from CPM. These slides will be uploaded on the CPMSoc Discord server if you want to review them later. Have a look at these resources. Also, we have some